If I would go back in time to January of this year, this is the stock that I would have purchased much more than I actually did. I've been buying this stock, but the stock has performed so well that I wish that I have purchased more of this stock. A lot of you might think that I'm talking about Nvidia, because Nvidia has been all over the news. It has been one of the best companies the last few years. It has been the center of the geopolitical tension between the United States on one side and China on the other side, because they produce the commodity that is going to dominate the 21st century. Now, if you go back to the last century, oil was the commodity that dominated the entire market. Whoever controlled the oil in the last century control the entire century. Now, whoever will dominate the semiconductor industry will dominate the 21st century. And that's why there is so much tension with Nvidia, there is so much tension with China, there is so much tension with Taiwan. Because while Nvidia designs the most advanced chips out there, guess who manufactures these chips? Exactly. It's a Taiwanese company that was once upon a time part of China and might actually again become part of China, which is called TSMC. It's a company in Taiwan, and they manufacture probably like 90% of the most advanced chips in the market. And that's why Nvidia has grown from a $100 billion company back in 2021 to now like $3.3 trillion company. And the growth for this year alone has been 180%. Even if you invested like a few $100,000 into this company back in January of this year, you would have done substantially more. Like, a lot of people even talk that Nvidia has turned into a bubble, even in the beginning of this year. And now it has grown substantially since then. Now it competes with companies like Amazon, Google, Apple, and the other tech giants out there. But if you compare Nvidia to the next company that I have on the list, it's absolutely nothing. Because GeneDx Holding Corporation has grown for this year alone by 2,172%. Do you see the difference between this company and Nvidia? And what exactly did this company do? It's a healthcare company that has used AI technology in order to diagnose patients' diseases much faster. So it basically took advantage of the AI in the healthcare industry. And because they have done it so well, their stock valuation has grown substantially. Now, how can a stock grow by this much? The reason that it can grow so much, because even after the growth of over 2,000%, the valuation of the company is $1.6 billion, which means that at the beginning of the year, the company used to worth less than $100 million. And that's the beauty of the stock market. That's the beauty when you go and find small companies out there, because they have much more room to grow. If Apple today would grow, let's say, by 100%, then its valuation should grow to $6 trillion. What are the chances of Apple to actually grow that much? When a company reaches some kind of a peak, the room to grow becomes significantly lower. But when you have a $100 million company, it can grow to $1 billion, it can grow to $10 billion, it can grow to a $100 billion company, and still have a lot of room to grow. And that's why, because this company has been so small, it could actually grow that much, even though that they are not doing anything super revolutionary. They're nothing compared to a company like Nvidia, because Nvidia has been fueling the AI growth in the first place. But it's a very difficult company to find something like that, because you have thousands of companies in the stock market, and you have hundreds, probably dozens at least, of companies that are doing the exact same thing. And for you to find such an investment, you have to be really good at analyzing financial statements, analyzing balance sheets, knowing how to find true valuations, knowing how to find future valuations. You have to be really master at that. And even if you do, even if you know how to do that, you have to be so good that you can do multiple companies in a very short period of time in order for you to come across such a company. And even if you know how to do all of that, it doesn't mean that you will find such a company, because you have so much companies out there in the market. How are you supposed to know that this is exactly the company that is going to use the technology so well and it's going to attract so much investors by the end of the year? So the risks with such a company are significantly high. And that's why if you get it right, the rewards are also high. The people who actually made real money out of this stock are probably the founders, the employees who had stock options in order to buy the stock at pennies and now sell them at a significantly higher price, and some angel investors who got into the business at such an early place. So when you compare it to the risk that you have to take, it doesn't really worth it for a lot of people, and 99.9% of people will never come across such a company unless it's a real luck. And that is why I believe that the next stock that I have in front of me, which is the S&P 500, is the best stock of this year. Now, the S&P 500 has grown by 23%. And if you compare it to the historical rate, which is 8 to 10%, 23% is really, really great. And you're not taking such a substantial risk. You're not looking into a very small company out there. Yes, of course, if you compare 23% to 2,172%, it's absolutely nothing. But think about the amount of risk that you are taking with one company and the other company. Now, the second company that has grown so much could have turned into a bubble. Chances that you will come across it is extremely small. But with the S&P 500, you're investing in the entire US economy. In order to be part of the S&P 500, you need to have at least a valuation of $15 billion. So this company automatically cannot even become part of the S&P 500. At least half of your stock should be publicly traded in the stock market. And you must have 4 consecutive quarters, profitable quarters, which means that the last 12 months, your company has been running at a huge profit, not at a huge profit, but the quarters has been profitable. And now, what really separates S&P 500 this year compared to other companies is that if you compare S&P 500 to a company like Apple, Apple also has grown as much as the S&P 500. Well, what is the big deal over here? Now, you see, Apple is a huge company. It's a stable company. It is a reliable company. It has the most powerful ecosystem on the face of the earth. There isn't a single company that could come close to Apple, but it's still one company. The risks with Apple are still substantial to a certain extent, at least if you compare it to the S&P 500, which is the backbone of the US economy. You have 500 or the strongest 500 companies on the one side and a single company on the other side. And when you are investing in the S&P 500, you're indirectly investing in Apple anyways. Do you see the risk and the reward? So with the S&P 500, you're getting significantly lower risk than you would take with Apple, and you're getting the exact same reward. And that is why S&P 500 stands out this year. Now, if you compare it to a company like Amazon, it's not just because Apple had such a bad year. Look at Amazon. It is growing by 25%. Now, 25% is a lot. It's not like, I don't want to sound like 25% is nothing, because if you're getting anything above 10% in the market, you are doing a great job. So when you get a 25% with Amazon, it's slightly higher than the S&P 500. Nonetheless, with Amazon, you are taking a substantial amount of risk. You don't know where Amazon is going to be a few years from now. And now, this year, Amazon grows as much as the S&P 500. Now, let me paraphrase that slightly. S&P 500 grows as much as Amazon, which is one of the fastest tech companies out there. Now, if you want to take a look at the companies that make up the S&P 500, you will realize that we have a lot of companies. We have Microsoft, we have Apple, we have Oracle, we have NVIDIA. And if you kind of give it a broader look, you will clearly realize that technology sector dominates it. At least probably like 20 to 25% of the entire S&P 500 are technology companies. But that is very, very misleading, because if you kind of pay a very close attention, you will realize that companies such as Google, Meta are tech companies. However, they are not included in the technology sector. Companies such as Amazon, Tesla, and other companies are technology companies, but they are not included in the tech sector. Now, some people might say that, well, Amazon is not a technology company. Amazon is a logistical company. They have planes, they have trucks, they have X, Y, and Z. Yes, that's absolutely true, and they compete with a company like Walmart. But what they have done is that they have digitalized online business. They have literally became the backbone of e-commerce, which makes them an online business, a technology company, because what separates Amazon is that they're focused on data. In fact, I would tell you more than that. The largest income of Amazon It's not even retail, if I'm not mistaken. The largest source of their revenue, or not the revenue, but the largest source of their profitable sector or the department of Amazon is Amazon Web Services, where they provide cloud services to other kind of businesses. And that's why Amazon is a technology company. The same thing that applies to Tesla. People sometimes compare Tesla and they would say that Tesla is a car company, is an auto business. Well, it's not, because if you compare Tesla to Toyota, for example, Toyota produces far more cars than Tesla. But if you take a look at the valuation of Tesla and compare it to the Toyota, you will find out that Tesla worth more than all of the car companies combined together worldwide. Why? Because Tesla is focused on technology. They're providing self-driving technology. They're trying to digitalize and they're trying to create AI technologies. They're trying to create software, and cars are basically a way for them in order to showcase that technology and show how it could be actually used. That's why, even though that Tesla is a car company, it's not really a traditional car company. It's more of a technology, and that's what sets them apart. That's what makes them different. That is their competitive advantage. And that's why if you kind of take a broader look at the companies that are part of the S&P 500, you will clearly realize that at least 40 to 45% of all the S&P 500 are technology companies, maybe even 50%. I don't really know. You have to do the math. And that's why the better you understand the tech sector, the more you can predict the direction of the S&P 500. And this change happened back in the 1990s when we had the dot-com revolution. And then it, of course, ended up with the dot-com bubble. But since the internet changed the world, more and more companies becoming tech companies in one way or another, and these are the companies growing substantially. Because with technology, you can have the most effective systems out there and impact a huge number of people and substantially grow your income, compared to a business like Walmart that has to sell physical things, that has to open physical stores somewhere. Historically, of course, S&P 500 grows by 8.10%, and it's a great hedge against inflation. Now, inflation has been growing it grows by around 2% annually. Sometimes it gets out of control to 8, 9, or even 11%, but these are very rare case scenarios. Usually it's around 2 to 3%. And when the S&P 500 grows by 10%, you can be confident that at least you're not losing your money to inflation. My favorite stock when it comes to the S&P 500 is VOO, which is managed by or issued by the Vanguard. It's a Vanguard ETF that invests in the S&P 500, and it has one of the lowest fees out there. So I'm not really telling anybody to buy that particular stock, but that is the stock that I buy when I want to invest in the S&P 500. If you kind of listen to Warren Buffett, he always keeps mentioning the first rule of money or the first rule of investing. And he constantly says that the first rule of money or investing is never lose money. And rule number 2 is that never forget rule number 1. Think about that. Why is he emphasizing so much on such an obvious thing? Don't people understand that losing money is bad and it's not really something they shouldn't do in the first place? And now I'll tell you why. If you take a look at the growth of, for example, the S&P 500 since 1945, you will clearly realize that most of the years has been pretty positive. Like, we have a few just years where the S&P 500, for example, went down, like in 2022, in 2008. This is when the dot-com bubble actually burst. But overall, it has been growing by around 20%. We had years when it grown by 30%. We had years, like the last 2 years, for example, the last 2 years, it has been growing by over 20%. 2020, it has grown by almost 30%. So why on earth do we have an 8 to 10% historical return when it comes to S&P 500? And that's because when you lose money in the stock market, when you have even a single year where the returns has been negative, it has a huge impact on your portfolio. Let me give you an example. If you invest $100, for example, in the stock market, and it goes down by 50%. Now, for one reason or another, you have actually got the wrong stock and now your investments are down by 50%, which means that this $100 right now have turned into $50 since it's down by 50%. Why did you do that mistake? Well, maybe because you're bad at investing, maybe you picked the wrong stock, maybe you invested in the stock that you have heard somewhere on the internet and you knew nothing about it. It doesn't really matter what the reasons are. Now, in order for you to get back to the exact same position that you were when you started investing with that $100, guess how much returns you have to make in the market? You need to make at least 100% just to get back to where you have been in the past. Do you see the problem? You lost 50%. Now you have to make 100% just to get back here. And that is the danger of making mistakes in the stock market. You're not even making any money at this point. You're not making anything. You are just getting back to the same place that you were when you actually started investing. And that's why if you want to take advantage out of the growth of the market, you have to minimize your mistakes as much as possible. They will cost you way more than you think. It's basic math, it's simple math, and that is something that even Warren Buffett has been emphasizing so much over the entire of his career. And that's why if you take a look at the stock market and the S&P 500 in particular, you will realize that, for instance, the market has peaked around this period, which was December 2021. But then in 2022, the Fed hiked the rates, and it took us 2 years just to get back to the exact same position that we were back in 2021. 2022 and 2023 simply were the years for the market just to get back to the exact same position. And that's why if you want to take advantage out of the compound interest, the number one thing that you have to keep in mind is that please do not make mistakes, because there isn't a more valuable lesson for you to actually learn if you want to actually take advantage out of the power of compound interest. Because as you can see that even with the S&P 500, you already can make substantial returns from the market, and you can actually build a very huge portfolio. You can retire by investing in the S&P 500, but only if you know what's going on. Because if you know nothing about the market, if your knowledge is limited about the market, even if you invest in the S&P 500, what could possibly happen is that you are going to sell somewhere here, and your growth that you actually did for 2020, 2021 will just disappear right in front of you. And that's because of lack of your knowledge. And that's why if you even don't want to become a professional investor and learn how to analyze stocks and do all of that, at least learn the basics, because those basics will at least help you to get started and invest reliably in the S&P 500. That's the least that you can do in order to become a good investor. Maybe from there, you can actually take it to the next level, but it will be a great place to start. Thanks guys for watching, and I will see you in the next one.